All right, so let's begin. So the agenda today is we're going to talk about three main areas. The first one being, do you really understand the finance of your startup, right? So do you really understand how the unit economics work and how, the purpose of a startup, the purpose of any business is eventually to produce income and to produce profit. So do you understand what it takes to get there? The second thing is talking about financial forecast, what to avoid when you are designing your forecasts of your startup. And the last one is to fund your startup. Once you get an idea of the unit economics and also the pitfalls that you wanted to avoid, then you potentially are ready to sort of raise fund out there and make your dream come true. All right. So the basic principle here is that you as the startup founder thinks in a lot of ways that, okay, the idea is number one and finance is just the job of the accountant or the job of your finance co-founder or your bookkeeper, right? That is in some ways true and false as well, because the numbers at the end of the day will determine whether your startup actually can be a viable business, right? So first things first, you need to understand what is the engine for growth for your startup, right? Like, there is a lot of one-time opportunity to make income, right? There's one-time revenue here and there, but is that viable? Is that sustainable, right? So you have to ask yourself that hard question. Is there a business on the activity of your company, or this is more sort of a consulting type of business or other type of business? Because as I will mention in the next few slides, the metrics and the unit economics for you to raise fund is totally going to be different if you are running this business as a lifestyle business, for example, right? Second topic is, whose responsibility is it? So this is a big question that a lot of the startup that I've met, a lot of the startup that I advise has concern about. It's like, oh, is this my co-founder's responsibility, or is it my responsibility as a CEO? The answer is, it is your responsibility as a CEO to know exactly the numbers that it's in your company, right? Like to know exactly if you're making money or not, to know exactly what the margin of the product that you're selling, and to know exactly as well what's the burn and what's the runway that you have for your company, right? So a lot of the pitfalls with a lot of startup is that they're really passionate about the idea, they're really passionate about the product and the solutions, but when it comes to the numbers and to show that the concept has some legs on it, that's where they stumbled upon, right? And then that's where the investors are going to be really hesitant in terms of proceeding forward, even though the idea and the product market fit is all there, right? So make sure that you know that it is the responsibility of you as a CEO or you as a co-founding team to understand these numbers really well. So the third topic here is, are you tracking the right metrics, right? Based on different organization, and I will talk about this further down the slide, you have two or three main KPIs that will determine whether your startup is alive or your startup is just hanging by the thread, right? So you need to understand what really moves the needle and to really, really pay attention and track those 2 to 3 main KPIs. And I'll talk more about the main KPIs depending on your type of industry. But try to reflect, after this meeting, what are the top 2 or 3 main KPIs that will drive your business for growth and for further scaling as well. And then the fourth thing is, people focus a lot on revenue, right? On growing revenue, but they miss their focus on also tracking the expense. So what I wrote here is that revenue is always a lagging indicator, right? It's being produced when you are doing things right, when you are hitting that product market fit, and you are hitting that segment of the market that you want to hit. Then you'll have the revenue as a lagging indicator to basically as a result of doing all those things. But you have to incur some of the expenses as well. So, pay attention to your expenses as well as you are going through your startup life. This is the number one killer in like startup environment is running out of cash, right? So it's never not enough revenue, but it's running out of cash, and that's determined by the expense, right? That's going uncontrollable, and eventually then you'll be running out of cash. And even though you have plans to hit the revenue to be 5x, to be 3x in the future, you won't have that runway. So really pay close attention to the expense. Right. So those are the main sort of like reminders and reflection for you to also consider after this meeting. Now going to the polling. Kenneth, do you have the polling set up?
Actually, we'll have to use the chat box here. So basically, you can tell us what you are
Sure.
what you are here in the chat box.
Okay. Yeah. So the purpose of this polling is to just really a question of reflection and understand who is truly responsible, right? To my earlier point, to who is actually responsible on the finance of your startup, and how often you are reviewing those financials and metrics, right? So while we're waiting for some of the result to come in for people who are providing some answer here, let's see, quarterly, okay, daily, weekly or bi-weekly, daily, weekly or monthly. All right. Myself, okay. So a lot of the people are actually managing the finance themselves, which is good. Got it. Okay.
That's good.
Yeah, let's just wait for a minute or so for people to chime in.
Yeah, looks like most people are managing
that
by themselves, and usually from weekly to monthly is the most common answer here.
Okay. Just wait for Ryan and Polonia to finish. Yeah, while we're waiting, okay. So it looks like weekly is the winner here, and yourself, and this is great because this shows that you are being responsible for your finances, right? And you're not relying on some external bookkeeper or external CFO or any other co-founder. I mean, your co-founder is the same as yourself, so that's why I put it there, just in case that you are you don't have that finance background. Maybe your co-founder has one. But I think overall the batches here is good, so we can move on to the next. And the importance of this slide here is basically, there's no right or wrong answer, right, in terms of how often you should track it. The point that you understand that, these numbers mean something, and these numbers are just indicators for something that you've done right or something that you've done wrong, right? So the most important thing is that you have a control over the numbers, and you understand how the different pieces comes together, right, in a simpler way, especially on the cash flow side. And then from there, you can make your decision, right? All right, so I'm gonna go a bit deeper here in terms of the various concepts. The first one being the most important is the cash, right? So with regards to the cash, these are some basics ones. So bear with me, guys, if if you're really familiar with this, right? The most important thing about the cash is you have to know what money goes out and what money goes in, right? And finally is like how much money you're burning each month, if you are still in burning mode, right? So if you're spending lots of money because you're pre-revenue, I think one of the company there is a pre-revenue company, then you'll need to understand how long will that cash in the bank will last you, right? At the rate that you're burning now, right? It's very simple, right? If you're doing everything through, one bank account or two bank account, and then you're doing all the transactions through there, then you can see, what money goes out, right? And what money goes in. I mean, if there's no money goes in, then it's pretty much, simply the balance divided by the money that goes out, right? Maybe you take an average of a couple of months of expenses, right? and then normalize to some of the things that are not, not usual, right? So if you have a big purchases for your first, if you're setting up a company and you're setting up your operation, there might be some capital involved, right? Then normalize that and focus on the operational expenses, right? Like how long can you survive on that bank balance, assuming there's no revenue comes in, or if you have revenue, how long can you survive if you're still in the negative cash burn scenario, right? If you have a cash zero date, meaning that you are burning cash, you need to understand when is that month going to be, right? That's why I said there, drill cash zero date in your head, so that you have this sort of date looming in the future, and you need to figure out a plan on how to avoid that date, right? Like a lot of the startups that I advise, they pretty much are too late in terms of identifying the cash zero date, which will then makes them, which will make them in a hard position, because then they have to make drastic changes, right? If you've got, the rule of thumb is you need to have about 6 to 12 months of cash, right, at any given point of time, so that 6 months is an absolutely minimum number of cash that you need to make. So you have about 2 quarters, of time to make those changes, right? That will hopefully create some impact on your inflow cash, right? But if you have about 3 months of cash left, then you need to make some drastic changes in terms of your staffing, in terms of your operational, and that will take away the focus to actually execute, right? So try to have about 6 months of cash in your runway. That's a good rule of thumb that I recommend to a lot of the startup that I advise. So cash is very important. That's why I bring it up number one. There is a lot of tools out there. This is just one link here that I'm gonna quote here, that allows you to calculate. If you are burning, $1,600 in this example, right? And then your revenue is only $100 weekly, right? This is weekly. You can change this to monthly as well in the calculator. How long does it take for you, at a certain growth rate here of revenue to be profitable, right? So there's tools like this that you can use in your forecasting later on to estimate actually how long does it take for me with this cash burn, right, of the revenue growing, right, to be profitable, right? So as you can see here, if you have 120,000 and then you are having this cash burn of about $1,500 a month, right? With growing 2.5% of revenue, then you'll be breaking even about in year 2 and a bit, right? So depending on the nature of your business, you can play around with the growth rate of the revenue, right? And you can even assume it's flat revenue here, meaning that you're just burning cash, right? And how long does it take for you if you reduce your expenses, right? So check out this link. I think it's really cool, high-level calculator that will help you understand when are you going to be profitable in the future. Okay. Kenneth's just typing the link there so everyone can have it. Thank you, Kenneth. Okay. All right. Revenue. Coming into revenue here. Some of the pitfalls here that I want to talk about is, if you are in the recurring revenue type of business, understand that, one-time revenue that you got from a consulting services with a client does not equal to the monthly recurring revenue, right? Monthly recurring revenue, for those who are not familiar, is, your subscription revenue that you are expecting to repeat every month, so that, your investor can understand there's some predictability in terms of your revenue, and also there is some security knowing that your software is being used month to month, right, or on a contract, right? So also, because SaaS is so popular these days, a lot of the startups are, okay, I'm a SaaS business, right? Like I'm a SaaS startup, but actually when you look down into their hood, you started to see that a lot of their MRR, or the monthly recurring revenue, is actually consists of one-time deals that are happening at different months, and then they're just calling it monthly recurring revenue. So make sure that you if you're saying that you are a SaaS business, software as a service, right, or hardware as a service, there's anything as a service, that you're actually really, billing your customers on a month-to-month basis, right? Sort of like a rent on your services, and it's not just like one-time revenue, right? So the second pitfalls that I see on revenue is a cumulative chart. This is present in almost every single pitch deck, especially with the early entrepreneurs or people who are just started to pitch their businesses. The cumulative chart here, the issue with cumulative chart is it's not really showing how fast you're growing in most cases, and it's really really not showing there's something wrong with the business, right? Early enough, right? So I'll show you an example afterward after I talk about this month-to-month growth rate here. So the other thing that I think is really important in terms of revenue is to track your month-over-month growth rate. This is really important because a lot of the startups are obsessed about other vanity metrics, right? As traffic, impression to their site, number of people actually signing up for their newsletter. But then when it comes to revenue, then they don't have the growth rate of revenue to support those claims, right? So month-to-month growth rate is, I think, a key KPI that all of the businesses should have in terms of really figuring out the pulse of your business, right? Okay, so this is a showing of why the cumulative revenue chart is so dangerous, right? So you can see here, revenue is going up to the right. We're doing great. We're gonna become a unicorn pretty soon, right? With this revenue chart, right? So, but in the actual growth rate, if you're really focusing on the month-over-month growth rate, as I showed you before, the actual growth rate here is actually slowing down, right? So yes, you are growing really fast in January, but then your growth rate started to taper off as you are going to September here, right? Just to give you a perspective here, right? It's looking really good. It's cumulative chart, right? But when it comes to growth, it goes like this, right? Then you'll question yourself, okay, why am I not getting the investor interested or getting people interested, even though I showed my chart to be going the right way, right? To going the absolute to the right, not going down. It's because you're not showing the right metrics, right? People who have done it, hundreds of times, investors that are very savvy understand that the growth rate is the key to how likely you are to succeed in startup, right? So this growth rate is really super duper important to show and to understand and to focus on, right? Okay, so now going to the expense. So I'm going to talk about some of the expense pitfalls here. The first one that I've seen a lot in terms of your forecast is not including any salaries at all, or including market salary in your forecast, right? This is very common, especially when you are starting up a business. You don't pay yourself, so you're just including zero all across the board until you hit profitability. That is not realistic, right? To begin with, even though that's what you wanted to do. It's because you are really not showing the true cost of the business, right? Same thing if you are not using market salary for the role that you are hiring, right? Yes, there will be a range of salary depending on the position, but if you're not using the market salary and you think that you're going to be able to get access to people with a lower salary expectation, and then you're building that into the forecast, that's also can be not realistic, right? Because at the end of the day, startup, the biggest asset in the startup is its team, and you want to have the best team that you can possibly hire using the funds that are available, right? So in doing so, you want to make sure that you are, capturing the right level of talent that you need, right? So by not using the market salary, you are again underestimating the cost, and it might cost you more. Okay, and then the other mistakes here is not including the employee overhead, which is, what if you hire an employee, it's not just the salary, right? This might sound basic for people who have hired employees, but for a lot of people, they don't understand that it will cost more in terms of the taxes, the payroll taxes, and also the benefits and other costs, overhead costs, right? So try to include about 20 to 22% of the salary for those types of costs. Also, the other pitfalls that I've seen again and again is using the flat expenses for entire length of your forecast, which is not realistic as well, in terms of the price, and also in terms of the cost of doing business, right? Again, I wrote down here, you should know your number, right? Period. Again, I'm going to repeat this again and again, but hopefully if you can, take away something from today's event, it will be, you need to really know your numbers. All right, so going to polling number 2, I just wanted to know, people in the room here, what sort of business model that you are using for your startup here. So if you can just quickly, we'll give it about a minute and a half to people to quickly put down their business model. That will be awesome. How we're doing for time?
We have about 10 minutes.
Okay. Yeah, for sure.
I think the Q&A session can be flexible, so it really depends on your end.
Yep. SaaS. Yeah. SaaS. E-commerce transition to SaaS. Got it. Usage-based. SaaS. E-commerce. Okay. SaaS. Wow, SaaS is
lots of SaaS.
Popular.
Yeah.
Yeah. Licensing base. Okay. I'm surprised there's no marketplace today. Licensing base, usage base. Okay. Direct sales. Okay.
So marketplace is like Uber, right? Like two-side marketplace.
Yeah.
So you're serving two types of different audience or users.
Yeah, you're basically the matchmaker of two supplies and demand, and you try to basically provide that, just like opening a market for them to transact. All right. Okay, I think we got I think SaaS is going to be our focus here. But I might skip over some of the other stuff that people don't have, like the ad space. You can skip that. Right, let's go understand here. Enterprise SaaS. This is what my prediction is. That's why I put this first. So the pitfalls, again, that I've seen from investor perspective is, your bookings is not the same as revenue, right? So if you have a signed LOI, you have a verbal agreement, but you haven't really done the work, or you haven't really get that, written agreement, you can't count that as revenue, right? It's only becoming revenue if you have done something, to that particular project, and your customers start to benefit, right? If they're just saying to you, I might use it for next year, then it's not revenue. You can call it potential bookings in the future, right? You have 100,000 in bookings for next year in the pipeline, meaning that you have 100,000 of potential revenue in the next year, right? But you can't say, I have $100,000 in revenue already, right? The other thing is the upfront annual payment. For those of you who are charging annual fee upfront, you need to basically recognize that, month to month, right? Because you are providing the service month to month, right? Your customer is not going to just use it one time in the beginning and then not using it at all. So same thing, when you recognize revenue, you need to do that by spreading out the revenue into 12 months, right? So you won't have this, like a crazy spikes of revenue as well at the same time, right? By doing so. And it's just any spikes will make investors think twice. It's like, what the heck is going on, right? Annual and monthly churn. Again, churn is such a over discussed topic, but it's still something that I think a lot of people don't have full idea about if you are SaaS. So try to be really specific when you're asked by the investor, what is your churn, right? Like try to say that your annual churn is X or your monthly churn is Y. And don't mix the two up, right? Because when you're going to do diligence and then they see that what you're stating to them is a monthly churn instead of an annual churn, that is a different conversation that you need to have, right? So make sure you know the churn and how it's calculated, and also make sure that you quote the right number when you're speaking with them. Okay. Marketplace, I'm not going to spend a lot of time here since I don't think a lot of you have marketplace business model here. So I'm going to skip that. The hardware, I don't think any of you has hardware, right? Okay. So gross margin is important for hardware. Oops, did I skip some slide there? Okay, now going into building your forecast, right? So this is how it works for me, and this is what I've seen work for a lot of startup as well. And this is the most I guess easy to understand methods that I can think of as well. So how to build your forecast? To me, it's a combination of two methods, right? So one is the top-down methods, which is basically working from the end. You're working from the 5th year. Usually a forecast is about 3 to 5 years, right? It's a long time. So 5th year to 2nd year or 3rd year, right? So this, why it's top-down? Because it is using the, that's your TAM, your SAM, and your SOM, right? It's using the market that you're trying to understand, if you're going to take over that market, right? And then also applying the growth rate for that market size, right? Let's say you are in the SaaS in healthcare, right? So you want to estimate how big is that market going to be in 5 years, right? Based on the current size and the current growth. And then from there, what you'll do is you estimate how much market share that you're going to be owning at the end of that 5 years, right? Be reasonable, right? But you can't really, say that you're going to be owning 100% of that market. It's good if you do that, but that's not realistic, right? So let's say you own 20% of that market, right? So you take that 20% and then you apply against the market size that you estimate that's going to be in 5 years. Then that is potentially the valuation of your company, in year 5, right? There's some other factors like the multipliers and everything, but roughly that will be the value of your revenue in 5 years, right? And then you work backward to see, okay, if I want to be a $20 million company in 5 years, and now I'm at 100,000, how does the growth look like from that 100,000 to that 20 million, right? Again, you want to see, whether you can be a $20 million company if your revenue now is, let's say, 200,000, right? You want to see whether that makes sense or not, right? And that's the whole purpose of doing top down. If you want to start from the end and then you move forward to the front, right? And then the second method is the bottoms up, right? So it should be a 2 here. It's basically to have a more realistic projection from the time 0, which is right now, to the middle of the session, right? To let's say the first to the 2nd year, right? So for this, again, you need to know the major KPIs, which I have spoken about before, right? Make sure that the major KPI is lined up with what your forecast is, right? And how does that translate into revenue? And then the beauty of the bottoms up is that you can also project the cost structure, right? What I mean is if you wanted to hit, $1 million in sales, and then you need salespeople to pitch your SaaS business, to enterprise, then you'll need to understand how many clients can that salesperson close each month, right? So then from there, if you want to hit 50, then you know that a salesperson can hit 10, right? Then you need 5, right? So that's why I said it's important to start from the KPI and then moving on to the revenue and then moving on to the costs, right? So then the combination of these two, the bottoms up, when you're doing these two methods, then you'll have a good reasonable forecast that hopefully in the middle you can sort of see, okay, the bottoms up, valuation is equaling to X, and then the top down is equaling to Y. So then, my potential valuation of my potential forecast, it should be somewhere in the middle, right? So this is a quick check to make sure that, the bottoms up and the top down make sense. All right. So finally, the final stage here is the financing. So if we can spend a quick 30 seconds here on the polling of where you are in terms of your stage of financing. All right. We're going to address some of the questions at the end, right, Kenneth?
Yes.
Yeah.
We have most of the questions answered during the Q&A sessions.
Yeah. Gotcha. Okay. Bootstrap. Okay. Friends and family. Okay. Self-financing. Bootstrap. Okay. Yeah, I think a good question there from Scott. We're gonna address it at the Q&A. How do you predict TAM for a market that hasn't existed yet? We'll table that for the Q&A for sure. And then question from Larissa. I think if you can elaborate a little bit more there too, we can answer it as part of the Q&A.
Yeah, looks like most people is bootstrapping.
Yeah. Okay. Cool. All right. So bootstrapping is even more important to understand a lot of the concept that I've told you before as well, right? To make sure that you know your cash, you know your runway, and you can really understand where the money goes in and out. Okay, so a couple of considerations when you are thinking to start raising, right? I know majority of you are still bootstrapping, but there's no pros or cons of one is the better than the other, right? It just depends on where your vision is about the business, right? So this is some of the consideration here if you wanted to raise. It is a full-time role. It will take you 6 to 12 months, right? People usually raise for the next 18 months, right? When you wanted to get into that growth stage where you need to be spending some cash in order to hit your milestone, your revenue, then you need to aim sort of 18 months of runway, right? And then, or you can add about 30% of your current burn into the forecast to see how much cash that you need, right? Don't try to raise too much money, or too much of percentage of the company in the early round, because it's going to end up hurting you more than helping you. So how much to raise? Again, you need to complete your forecast before, right? Especially on the cash flow side. And then you need to calculate the cash burn. You need to get into the milestone. Again, emphasizing how important it is to know your KPI. What are your top 3 KPIs, right? And then the total cash burn from all the months when you're forecasting is pretty much how much money that you need, right? To hit that milestone, to hit that next level, right? When you're building the forecast, ensure that you're also doing the worst case and the best case scenario to add some buffer into it. What you don't want, again, as I mentioned, is you don't want to be, 2 months from your cash zero date and then you start to panic, right? You don't want that. So you want to add some buffer so then you don't have to continuously raising money nonstop, because that's going to distract you fully from running the business. I think I have this slide. Okay, so bootstrapping, some of the key points here is that you maintain full control over the company, which is what you want in the beginning, right? When you started off. The second best option, I think, is doing the grant financing. There's a lot of grants out there that are non-dilutive, right? Oops. Take airplane, Kenneth.
Yes.
They're non-dilutive, so a lot of the SRED funding from the government, or some of you in the US, they have similar program where government can give you some grants that you can match with cash, either 25%, they'll give you 75%, or 50-50, right? So So make sure that you take advantage of all the grant financing that you can possibly take advantage, because these are non-dilutive and some of them are non-repayable as well. So it's pretty much like almost like free money, right, for you. The safe one, for those of you who are not familiar, this is a simple agreement for equity, right? This is coined by Y Combinator. And this is one of the easiest way to get funding for your startup, because what essentially it is that, okay, Mr. or Mrs. Investor, if you invest in my company now, the valuation, you will get, you don't promise them, a certain shares right now, but you said that you can get, your investment can be valued up to X, valuation cap, right? So if you raise more than that, then that means that they enjoy the benefit of raising at the higher valuation, right? So doing a safe would be better, because then, when you are trying to get investors with the other methods here, with convertible debt and common shares, you need to basically set the same terms for everybody, right? Like, okay, I'm gonna raise money, the valuation pre-money is 5 million, and then everybody has to have the same terms. With safe, you don't have to, right? So sometimes when you need a couple $100,000 to just get things off really quickly, a lot of the startups are using the safe method, right? There's tons and tons of materials out there with safe. I'm encouraging you to go to YouTube or to Google to get more understanding. But this is one of the easiest way form or format to get the investment, right, from people. And then you have the convertible debt, which means that Mr. or Mrs. Investors will invest money, and then it is like a debt. It has interest payment on it, but then at the end of the term, it could be converted into shares at a fixed conversion rate, right? So it's similar to safe, but everybody on that round needs to be set on the same terms, right? And then common shares, this is usually later down the road as you progress through, right? So this is less relevant for you, but it's just more expensive paperwork-wise in terms of the lawyer costs and everything. And then the debt financing, which you might heard out there, BDC and a lot of the other companies, bank included. This is more like if you have already have a certain revenue base, right? Like you have predictable revenue coming in, then you can start to look into that. But I really not encourage you to do debt financing at all, like when you're starting off your startup, because then you can be also personally on the hook for that. And also, investor usually wanted to stay away for companies that are loaded with debt, because they are last in terms of when something goes wrong with the company, they get paid last, right? So you wanted to try to avoid debt financing as much as possible, unless you have the revenue to back up that loan payment that you need to make each month. All right, I think we have 2 more slides, right? Yeah, I'm gonna fly through this a little bit. So pre-money and post-money, right? So this is another pitfall. When you're discussing with investors, I'm gonna give you 100,000 for 10%, you need to be very specific. Is that pre-money or post-money, right? If it's pre-money, that means that after their investment, the total value of the company will become 1.1, right? $1 million with 100,000 of their money. So then investors will actually get 9% of the company, right? But if you said to them, 10% for 100,000 with that, then you'll actually giving them more than that 9%, right? So just be careful when you are, offering these terms to the investors. You make sure that you have the pre-money or the post-money to attach that with your conversation. Overvaluation, this is pretty clear. You've seen all the startups are raising money like no tomorrow, right? Or all on very hyped up valuation. You don't want to do a down round in the future, so be realistic about your valuation, right? Under raising, this is where I think a safe would probably be better, right? To hit certain milestone, and then you can raise another round of financing. But if you're under raising and you already load up yourself with expenses, because again, expenses is a leading indicator, right? Revenue is a lagging indicator, right? That I've said before. Then you won't have enough money, right? And then when you don't have enough money and when you have only 3 months of runway, your position of negotiation is really bad, and you don't have that. The ball is not in your court. All right, so the takeaways here is, you have to understand the business and your unit economics, right? You need to understand the revenue structure. You need to understand the expenses and make sure that you forecast them really, realistically. Don't underestimate your expenses and overestimate your revenue. Sounds cliche, but it is, every single forecast will have that. Second, revenue is a result of your product market fit. So we're focused on getting to this product market fit first, right? If you're not doing enough customer discovery, if you're not talking to enough customer segments, and you start building, make sure that you pause and step back, right? Is something that I'm building right now, is it something that a lot of people are going to use, or this is just a nice to have, right? Really ponder and step back and really criticize this baby of yours that you've created, because the startup is like your baby, right? So you want to really criticize whether this is really a problem that that a lot of people are having, and it is a big market that a lot of people will pay for it as well, or is this something that is very niche, right? The third thing is control your burn, or it will control you. Again, I don't have to repeat this. I think you all know. Raise funding. The only way you should raise funding is to hit the next milestone. It's not to stay alive, or it's not to pay for your operational costs. It is to hit the next milestone in your business. So if you haven't seen the next milestone yet, or don't have any intention to hit the next milestone, then don't raise, right? Don't raise for the sake of funding your operational. That's not going to bring you anywhere, and that's going to bring a problem with investors, because they will expect 5 to 10x of their money back, right? Like if you're not planning to grow your business, then it's hard to be 5 to 10x the value that your company is in right now. And finally, again, this is cliche again as well, is like you should really know your number. So yeah, hopefully that's helpful. I know I'm going a bit over time.
Let's hit the Q&A.
Yeah.
We have a couple of questions
Sure.
that people asked before. What do you predict TAM, total addressable market, for a market that as yet doesn't exist?
Yes. So for this one, there's a couple of ways you can predict the TAM here. The first one is knowing what alternative, right? Like what is the solution out there that people are using to solve the problem that you are trying to solve, right? Is there an alternative out there, right? If there is, then how big is that market, right? Because most of the time you are trying to invent something to improve the things that are already there, right? Or if it's not there at all, then you'll need to do more customer discovery to understand, okay, what are the customer segments that I'm trying to target with the product that I want to sell, right? So let's say you're targeting millennials, 20 to 30 years old, with a certain income, right? And then you can also predict, okay, how many in North America, or in Western Canada, or in Western US, right? Depending on how you want to try to target your market first. And then from there, it's like, okay, how much are they willing to pay for your product, right? Like if they're wanting to pay $20, and then you have about let's say 20 million people, right? $20, that's like 400 million, right? This is a very rough estimation, right? But that's how you sort of use the demographics to figure out the total size of the market, right? Investors are looking for reasonability, right? At the end of the day, they need justification on how you actually arrive at that figure, more so than, where did you get this number? Like, is it from a trustable source or not, right? At the end of the day, if you are showing how you arrive at that figures, reasonably, I think that will be okay.
So next question, what are the best ways to use the funding? So I guess assuming you raise the funding already, what are the best ways to use?
Yeah. I think this is part of before you use the funding, you need to have a plan for the funding, right? The best way, I think it really depends on what KPI you wanted to hit, right?
And also depends on the stage as well.
Yeah, exactly. If you wanted to hit user growth, right? If you wanted to hit if you are a SaaS and you wanted to really be used by the Fortune 500 companies, then you need to hire some of the best enterprise sales, right? In that case, you need to really invest in the sales and marketing channels, right? While if you are an AI type of company and you are using a lot of the IP, you're building a lot of the patented technology, then you wanted to use that for your development, right? So whatever it is, again, coming back to what is the KPI of the success that you want to hit. Like in 3 to 5 years, you want to have, you want to have, let's say 50,000 users, right? Or you want to have, a technology that is able to process, X millions of data points, right? You need to set that really clear. And then from there, you determine how to get there.
So next one is we'll go over the questions one by one, and then if we go over, we can answer the questions, and then I'll record it, and then I'll send the links and upload it to YouTube as well, so you guys can also listen to it if you have to go first. Okay, so next question: what kind of funding options for friends and family one? Is this still using Safe?
I think a Safe would be easier, right? In terms of raising money from friends and family. The only thing with the common shares is that you need to have some filing obligation. You need to have some share certificate issued, right? There's some legal costs, more legal costs involved, right? So if they are comfortable, then a Safe would be good, right? Because a safe generally guarantees that in the event of future equity financing in the future, then they'll for sure get this max cap of valuation, right? So which is usually on the lower side, because then your next round would be higher valuation. So they get to invest early, then they get to enjoy lower valuation, right? That I think is one of the quickest way to get funding. I think using a Safe for friends and family is one of the quickest way to get funds.
Yeah, especially early on, you can take out the negotiation of the valuation part as
exactly.
well. So, yeah.
Exactly.
Next questions. Maureen has the question: people product research. What that is?
Oh.
The context of the questions might have been questions that relate to what you were talking about. Maybe.
Okay. Maybe we'll let
already. So next questions. How do you estimate churn rate for a new industry that doesn't have any stat on that matrix?
Okay, so the churn rate. I think this will be quite interesting. Again, the way to look at it from a top-down level is to sort of like understand, okay, how likely they are, like, do they have alternative, right? Like first thing first, do they have alternative? If not, is there anybody else in your competitive sphere that is offering the same product, right? And if there is nobody else is doing the same thing as you are, nobody's in your industry and no other competitors, then I think it will be hard to estimate the churn. But I think a reasonable churn, right? It's about 5 to 10% annually, right? Like that is considered to be, like, for early startup, that's considered to be really good, right? If you can hit the 5 to 10% annually, not monthly, okay, annually, then there'll be a good starting point, right? Like obviously you are going to be the guinea pig of your industry, right? Then you need to explain that to the investors as well on how you arrive at that 5 to 10%.
Yeah. So next question: could you provide an example of using Safe method of funding? I.e., Mr. Chen will invest 500K and you forecast a valuation of 5 million down the line. When do you set that equity? So when do you set the valuation? I think that's the question.
Yeah. So again, with the Safe, it's a simple agreement for future equity. So meaning that what they have right now is a piece of paper that says, if we are raising money in the future, if we raise a certain amount of money in the future, then we'll honor your money that you invested in us right now at a minimum of this valuation, right? So let's say Mr. Chan invested when valuation is 5. The cap is 5. The minimum cap is 5, and then you are raising money. You're becoming more successful. You have more traction. And then the next time you raise money is on $10 million valuation, right? So equity financing. So this will protect Mr. Chan, right? That he is getting almost 50% discount of the future valuation in the company, right? So instead of investing $500,000 at 10 million valuation pre-money, which gives him about only 5%, right? He'll get 10%, right? By using that 5 million pre-money valuation set, right? So the other investors, which doesn't have SAFE, which comes in at a common equity round, right, will then be investing at a $10 million valuation. There is actually a very good YouTube video by the Y Combinator CFO. Y Combinator is actually the first one who came up with the SAFE term, right? They have a very good examples. Can you send a link after the session?
Yeah, I'll send the link.
I'll provide you with the link, and then this is a very good step-by-step example of what the impact is of the dilution to you and also the other investors. If there's a SAFE coming in, if there's a convertible debt coming in, and what is the end of the day your eventual ownership, right? Be careful though with SAFE. This is something that actually happens, right? That's talked about in Y Combinator is you can actually sell more than your company, right? You can actually sell more than 100% of your company, right? You're not supposed to, but if you forgot, if you forgot, you can actually do that because when you're issuing a SAFE, you're not issuing shares, right? You still control the shares, but in the future you'll be diluted when those SAFE convert into equity. So just be careful not to, let's say you issue, let's say your valuation cap is $1 million, and then you issue, each one get 50,000 investment and $1 million, and then you're selling instead of selling only 10 or 20 of those types of SAFE, then you are selling like 30, right? 30 times 50K is a 1.5 million, right? So in this case, you are going to negative, right? So just be careful.
A new company.
Exactly. So in this case, then you be actually owing them companies, half of the company, more than half the company. You have zero, right? You have nothing to give out. So just be careful when you're using SAFE. You have to calculate how much actually the dilution impact is, and how much actually left of the company that you can sell to the investors.
That's good. So next question, Grant asks, do you have sample document template that you could follow? Financial statement, forecast, presentation. That is need to look for funding in Vancouver. Planning to settle down in Canada next year and expand my product in North America. So some financial documents that they can use as template when they start out.
I don't have one that is generic enough for it to be useful, but I think if you Google like financial template, there's tons out there, right? As well as I think SlideShare has a lot of resources in terms of the good pitch deck. One of the good ones that I really like is presentation from Uber and also from Airbnb. I think they're really super clear in terms of conveying their values and their product market fit. These are the very early pitch deck that you see from them, so it might look not like exactly polished, but they're becoming where they are right now with those pitch deck, right? But the game now has been elevated up because everybody now has to understand the product market fit. So yeah, I think the key points is to make sure that you have that product market fit, right? And then the rest is sort of like fitting the puzzles all together, right? And I think Kenneth's program with Startup Boost is a really great way as well to discover that product market fit that you really need, right? Right, Kenneth?
Yes. Hopefully the mentors and the mentoring, one-on-one mentoring can definitely help the startup set up looking to fund that product market fit. Yeah. So next question, Sudip mentioned, what are the grants available for startups in the US? If you have a few reference, can you please talk about? Are you familiar with grants in US? We're based in Canada.
I don't, but I think kind of you have the resources from your US colleagues, right? In terms of,
I'll dig into that and help you in that way as well. So next question. So investors using SAFE don't actually get equity until the future round, right?
Exactly. So here is the beauty of the SAFE is that, you can raise now, right, in the early stage, and then you can raise a few $100,000 with a certain cap on the SAFE, and then later on, the next 3 months, right? The next 3 months, if you have more traction, then you can raise again on a SAFE and have a different valuation cap, right? Like it's a higher cap, right, at that rate, right? So then you don't have to wait until you hit that milestone. If you have already investors that are ready and wanted to believe in you and wanted to start investing right away, right, you can do so. While if you're using a convertible debt or you're using a common shares, because it's based on series, right? It's a series 1 preferred shares. For example, all the investors have to have the same terms, and usually there's a lead investors who's going to set the terms for everybody else, right? Then you're playing the chicken and egg game where, okay, I invested if he invested, right? I will invest if they invested, right? So you have this back and forth kind of way, right? Because they wanted to have the same term, and none of them is comfortable becoming the first money in, right? With the SAFE, it's usually, the highest reward for the investors who's investing in the SAFE because they're usually set at a lower valuation compared to a common shares and a convertible debt. And Kenneth, feel free to add more if you have.
Yeah, and you save time. Yeah, you save time in terms of negotiating, right? And you don't need to get all the investors to agree on the same term to get you the money. So it basically saves you a lot of time. Yeah. That's good. So do you have more questions from the audience, from the attendees today? Okay, do you still need lawyers to draft up the SAFE paperwork like common shares?
There's actually a lot of templates that you can use to be absolutely safe. Of course, you wanted to have a lawyer to sort of like take a quick look, right? And make sure that you are getting the lawyer that are specializing in startups, and they can just, quickly do a 2-hour, not more than that, review, 2-3 hours max should be more than enough to review that. At a $500 an hour, it should be around $1,500 compared to, I think in Canada, if you want to raise a convertible debt round or a common shared round, I think it's usually taking like 10 to 15K, right? I think that's the normal cost. I think, I don't know if you've seen it differently, Kenneth, but that's what I've seen from the going price of the market, 10 to 15K to raise a common round or convertible debt round because of the paperwork.
Yeah, all I know is that lawyers cost a lot of money, so that's the safe answer. But so templates are useful, but I think it's safe to have lawyers to go over it and review it, especially like Andry mentioned, someone that are familiar with the startup scene, that are actually doing tech startups related legal documents. So they are more familiar with the terms and the things.
Mm-hmm.
Yeah.
All right.
So next question. Do we have more questions?
Turn on the lights here. Started to get dark, really.
Oh yeah, it's good. Yeah, we're getting through the summer, and we.
Yeah.
Yeah. So looks like we covered all the questions that attendees have. So let's give Andry one big round of applause to help sharing the ideas and sharing all the knowledge in terms of how to manage the early stage finance for your startup and how to fund your prepare the funding for your startups. Hopefully that will be able to help you both you and your startups to prepare getting funding and getting to the next level.